6.38%. That is the 30-year mortgage rate. And somehow, housing still does not feel affordable. If mortgage rates are down from last year, why does buying a home still feel impossible? In this episode, we break down the payment math behind a 6.38% mortgage rate and why lower rates alone are not enough when home prices stay high and supply stays uneven. Right now, the 30-year mortgage rate stands at 6.38% as of March 26, 2026. 1 year earlier, it was 6.89%. That is a decline of 0.51 percentage points, or 7.40% year over year. Yes, that is real relief, but it is not cheap money. Historically, this is lower than the recent peaks, yet still high enough to keep financing costs heavy for anyone trying to buy at today's prices. On the chart, the story is subtle, and that is exactly why it matters. You see mortgage rates pull down from last year's higher level, but not collapse. This is not a return to the ultra-low era. It is more like a step back from the ledge. The line eases, then holds in the sixes. That creates a psychological shift. Buyers hear that rates are falling and expect a reset, but on screen, you can see the real problem. The decline has been modest, while affordability damage from the earlier surge is still baked in. Now add the other housing signals. Median home price is $45,300, down 3.34% year over year. That helps, but only slightly because the price level is still very high. Housing starts are 1,487.0 thousand, up 9.74% year over year. That matters because builders are trying to add supply, especially where resale inventory has stayed tight, and the federal funds rate is 3.64%, down 15.94% year over year. That tells you monetary policy has eased, but mortgage rates do not move one for one with the Fed. Treasury yields, inflation expectations, and mortgage spreads matter too. Put together, these numbers say the market is adjusting, not healed. This is why the housing market can feel frozen even when the headlines sound better. Mortgage rates are lower, home prices are softer, construction is improving, and yet none of those moves is large enough on its own to fully unlock affordability. The payment burden remains elevated, sellers are still anchored to older valuations, and buyers are still waiting for a deal that may not arrive nationally all at once. That is not recovery. That is friction. Here is the math that changes the mood. On a $45,300.0 home with 20% down, the loan amount would be $324,240. At 6.38% on a 30-year fixed mortgage, the principal and interest payment is about $2,023 a month. At last year's 6.89%, that same loan would be about $2,132 a month. So yes, the lower rate saves roughly $109 every month, but the payment is still above $2,000 before property taxes, homeowners insurance, maintenance, or HOA fees. Add just $500 to $800 for those costs, and many households are looking at a monthly housing bill closer to $23 to $223. That is why the market feels stuck. A rate drop can improve the math, while still leaving the total bill unaffordable. We saw versions of this in past housing slowdowns too. Financing conditions can improve before buyers actually feel free to move. So the big takeaway is simple. Lower mortgage rates are helping, but they are not fixing housing on their own. At 6.38%, the pressure is lighter than a year ago. Not gone. Subscribe to Brick and Yield, because next we are watching whether more supply finally breaks the freeze, or whether affordability stays trapped in the sixes.